sometimes when you want to move forward, it's not a direct line forward. So there's this book called The Squiggly Career, and actually the line should be going all over the place, because that's when you learn and you see the breadth. And don't be afraid to move sideways, even if it's sideways and a little bit back, because then you might find that you've opened up something that you can move much more quickly in, or it can advance your career in so many different ways. If we want pension funds to come in and create more homes to help us, we need to show them that there are good returns. And not be ashamed about that. But at the same time, you can create social impact.
Welcome to the People, Property, Place podcast. I'm absolutely delighted to say that we are joined by Quintain Webster, CEO of Thriving Investments. Formerly known as PfP Capital, Thriving Investments is a leading fund manager with a social conscience. The business already manages 3 living strategies, totaling 700 million, and so far it has acquired and delivered 3,500 private rented sector and for sale homes, and has 6 regeneration projects underway as it targets 20,000 homes over the next decade. Prior to joining Thriving Investments, Quintain was an executive director, strategy investment at Quintain, and has previously held roles at Hudson Advisors and Lehman Brothers, among others. She has an MBA from INSEAD and is a graduate of the University of Reading, and it gives me great pleasure to welcome Kath to the podcast. So I'm really excited to unpick your career and how you've got into property in the first place, but also flip between the debt and equity side throughout your career. But can you just tell me and the listeners a little bit about how and why you got into property in the first place?
Yeah, serendipitous, I think. Generally, I think it was sort of one of those things when I was at school that I was vaguely good at maths, quite liked a bit of geography, didn't really like sitting still and thinking and being part of a sort of a job that was a process, and wanted more of a sort of, I don't know, outdoors, thinking about things job, which is going to sound horrendously vague, but actually somebody came in on a talk to the school and said, I'm a surveyor and this is what I do. And, you get out and you're meeting people and it's a market. So we do transactions and, it's all about thinking about the economics of markets, etc. And I thought, well, that sounds interesting. And went entirely for things after that. So it literally was that one person back in the 80s coming into the school that sort of triggered all of that.
And you had no family or no kind of prior context of real estate as an industry as a whole?
No, not at all. My dad's he's retired now, a master butcher, and all of his parents and predecessors were in that, and my mother was a teacher, so like nothing at all alike it. So it is just that serendipitous moment of meeting somebody and sparking those ideas.
Wow. So how did you take that kind of chance meeting, and how did that evolve in terms of how did you kind of plot out the university and the next steps?
So at the time there were only a few universities doing the course, but I ended up at Reading doing the land management course there, specialising in real estate, investment and finance. Again, it's because I've got more of a maths type brain, and sort of that felt like the area of interest for me. And then came out and did the surveying, to get my EPC, is that what it's called? No, it's EPCs aren't, but APC. Thank you. I'm getting my
Get your
PCs.
MRICS.
Yeah, so I got that, and I'd worked at what was Weatherall Green and Smith back then. It's changed its name several times. It's now part of BNP Paribas, but all the people who were there are. I did a rotation through in all the different areas of surveying. But I think I also quickly realised that whilst real estate was of interest to me, I moved quite quickly actually after qualifying. And moved into a very small company looking at fund management for a big US pension fund that's still investing. And that was way more of interest to me than doing the agency side, which frankly I wasn't very good at.
Why was it more interesting? And what experience of surveying had you had, or the rotations that you had up to that stage?
Well, so my first one actually was in business rates, which I was horrified about. And I don't know why I was horrified about it, but I think it didn't seem a very sort of sexy area, did it? Thinking about, business rates. But it was an extremely good area to learn in, because it's valuation. It's thinking about a lot of the different points about why property is good and not so good and how that compares to other things, and negotiation, which fundamentally is a massive part of this business. And so actually it turned out to be a really good place. And then I moved into our city office, which at the time, this was the early 90s, the city was dead, huge oversupply of offices, and all rent reviews were basically coming at nil increase. But we were doing rent reviews on some of the retail there and looking at some of the alternative use going on and valuations. And I found that all very interesting. But as I say, I did a bit of investment agency there and realized that I wasn't very good at the agency side of it, but I liked the investment side and why you should be doing it. And therefore probably felt that I wanted to be more client side than advisory side.
And at that stage, was it very much a well-trodden path? Go and get your letters, go and join the agency world.
Yes.
It wasn't you can go and be a principal or go onto the client side straight away.
No, it was quite hard. Yeah. And again, I think with all of these things, it was serendipitous that I met some people who were setting up and coming out of Lend-Lease. And it was a company called Parks and Company run by Gerald Parks. I happened to have met somebody who was there as one of the sort of founding people, and they wanted a junior, and
you stuck your hand up.
I think that's it. I was sort of smiling and being inquisitive at the right time. So right time, right place again.
And so what was the role that you went on to do at that business?
So I was basically working with the fund managers, investment managers, and helping them sort of do due diligence, find properties, do the modeling, write the reports, all of that sort of stuff. But it was learning from some very experienced people. I mean, it was sort of, it was a very small company. I mean, I think I was the second employee other than the founders. But, at the time we were in an office of 5 of us. And so I was learning from people who had years and years and years of experience, which was, that was the deciding factor for me, really. It was sort of, much as I loved being at Weatheralls, I said I wasn't very good at it, but I really enjoyed being there. You'd learn from the people above you, and there were hierarchies to that. I jumped that and was learning from people who've been in the business for decades and was learning huge amounts and being taken to every single meeting. And, the sort of the learning curve was very steep, basically. But we were buying properties for TIAA. So at the time, it was one of the largest pension funds. And it was basically buying assets in the UK at the time. It then expanded to Europe while I was still at Parks and Company. I actually moved into a different role at that point.
And in terms of the investable universe, office, retail and industrial at that stage?
Yeah, exactly. We'd been buying retail parks. We had offices, and we were doing it mainly in joint venture. So we were doing joint ventures with the predecessor to Delancey as a corporate, so with Jamie Ripblatt, and also had done stuff with British Land, etc. But that's what I mean. You were meeting some of the real heavyweights in property and getting to speak with them and understand it. So as far as the learning curve, it was superb.
Yeah, it sounds absolutely phenomenal to kind of work with people who had decades worth of experience.
Exactly.
And kind of sit in their pockets and learn all the tricks of the trade and how they looked at things. It must have supercharged your experience compared to your peers who are still on the advisory side.
Yeah, I think it was just a completely different path. I was learning about things that were, and also, my curiosity was being piqued in very different areas. And it was being spread across a very wide area, whereas a lot of my peers were becoming very, their experience was probably more than once they had come through their RSCS, they'd gone into a department and were learning that and becoming experts in it. I was not an expert in anything, but I was getting to learn lots of things. And actually that is way more my sort of personality. And my patience level and my ability to concentrate on lots of, on something for a very, very long time and get deep into it is limited.
And so what was the next move after Parks and Company, and why did you decide to change?
So actually I moved internally in Parks and Company away from the fund management side and moved into the corporate finance side. And that was an area that had been set up to advise clients. So actually I went back into advisory. But they needed someone who was junior, who could again come in and learn it. And it was a step sideways, possibly backwards. But the general point about it was that we were buying for teachers with all cash. And a lot of the people we were buying with were putting debt against their portion of the joint venture. And when you spoke to them about why they were doing it, it was very obvious that at the time, I know things have moved since then, and this is the 90s, but if you were cash flowing something on an asset of 7-8% and could borrow at less than that, the positive leverage meant that you were getting better equity returns, and the risk profile wasn't massively increased. So the corporate finance side of things was sort of, and again, another area that I hadn't really worked in at all. And I wanted to learn. So I moved into that and started working with people who had been in banks and advisory sides, and was learning from them, but realized that there was a lot more to learn. And probably the gaps in my knowledge were much bigger than they had been on the property side when I was learning that, because I had more of a basis in that. And so that's when I went to do the MBA. I actually went there on a bit of a circuitous route as well, because I decided that I was going to go and do an MSc in corporate finance at London Business School, because that's what I thought was missing from my knowledge. And I went along there and went to the evening all about it. And, this is how you apply and this is what it's all about. But I'd done a load of research and really thought that was the right one. But they sat there and said, just to be clear, if you guys want to learn about management, marketing, how to run a business, all these other things, you're in the wrong room. You need to be next door in the MBA room. And please don't start this course thinking that we're going to teach you that, because we're not. I'm paraphrasing. And I sat there and thought, I do want to learn about all those things as well. Why would I just limit myself to only understanding this one part if I'm going to be investing? Because it was quite a big amount of money that I'd be spending to do this. And so I went next door and sat with the MBA and thought, oh, okay, this is quite interesting. It's a much longer course. London, I think, was 2 years. It might not be now, but it was 2 years at the time. And not earning for 2 years and investing all of that money, basically, and having to live in London, which we all know is not cheap, felt like too much of an expense. So that's how I ended up at INSEAD instead. It's 1 year. It was in France, which is a lot cheaper. So the opportunity cost or lost salary or whatever it was in terms of the investment I made was less, but it's still a prestigious, it's a very prestigious MBA. And I figured that I would, learn more quickly.
Had you self-identified this, or had you had a mentor, that kind of guided or helped you
I've had
at this stage?
Tons of mentors, but it was, I think it's always the fact that part of it was self-identified, and part of it was that I had spoken to people who'd done MBAs and then asked them about it. But the MBA part was, as I say, really only came out of this MSc conversation in corporate finance. And that was me basically not feeling 100% comfortable that I knew exactly what all of these things that people were talking about. And, trying to learn off other people who were trying to work all the time is great. But actually, having a solid basis is also, from my point of view, much more comfortable.
So did the MBA plug the gap or the hole that you...
It definitely did. And it gave me so much more. I think, so the finance part, yeah, definitely. But it was all the other stuff around it. And actually, I think quite a lot of it was just, it gave me an opportunity to sit back and think, because, I'd been running quite hard up until that point. I'd been learning lots. I'd been working, very long hours and never really stopped and sort of tried to amalgamate everything. And actually, this was a chance to sort of sit back and think and look and sort of see things from the outside. But also because I was pretty much the only person there who had a real estate background. There was a person I'd met who was a lawyer who'd worked on some funds with me. But other than that, there was no one else really who had that. So seeing how other people viewed what they were doing and what I did and everything just gave me way more perspective on life, because I had come through a degree in property, from Reading. So there were tons of us who came out as graduates, gone straight into the surveying. Again, everyone around us was in that sort of, those tram lines. A lot of my social life was with people who were from Reading and all the rest of it. So being able to come out and sort of see the world from a different place, especially for real estate, because we're serving all of those industries, right? We're trying to find solutions and make sure that the property and the infrastructure and everything we've got works for those people. It was a great time to sort of sit and take stock.
You then landed at Hudson Advisors,
Yeah.
Lone Star, if I'm not wrong. How did that come about, and what did your kind of role look like there?
Well, so when I did my MBA, it was early 2000s, so we just had 9/11, so that was fun. And I think I've made a bit of a habit of trying to find a job coming out of university. Was in a recession, and then 9/11 caused, we'd had the dot-com crash, and then we'd had all 9/11, and I just distinctly remember everybody coming into the business school and saying, well, normally I'd be telling you that we would have X number of jobs, but we don't this year. We're just coming to say good luck. You were like, oh, this is going to be fun. But I think, again, I wasn't going to go down the sort of the investment bank or the management consultant route, who were the people who were sort of coming in for the milk rounds. Had to find it by myself. I'd been in Europe. In theory, I'd learned 2 foreign languages. And I wrote an email. I did in my Spanish exam an essay on shareholder value, which I was thinking about this morning, and I couldn't even tell you any of the words at all in that now, but there we go. But I sort of came out feeling that I had this European presence now, and it only really worked in the UK up until that point, and really wanted to sort of be able to, use languages, etc. Rather naively, probably, but the Hudson role, working with Lone Star, was all about buying across Europe. The office was based in London, and that fitted me perfectly. The opportunity to be, again, with some very senior people who'd been in the industry a lot. I could learn a lot from them, and then take that and apply it to different things around Europe and different markets was really the very interesting part of that role, which we did. I didn't stay there very long. There was a very strong reason for that. I loved it there, but I moved actually to Lehman. Having said I wouldn't go to an investment bank, I then did. The Hudson roles actually moved everybody to Germany. And I could see this. They were moving generally people on a sort of, every month there'd be another sort of person who'd get you and your family are now moving to Germany, because that was when all the non-performing loans from Germany were coming out, and they could see that as a very big growth area for them. From a personal point of view, I didn't want to move to Germany. And so I realized that actually I needed to find something else that was sort of based in London, but could still provide that. And at the time, Lehman was absolutely doing that. So I moved in to do their equity co-investment, and also you could do mezzanine loans as well within that group.
So someone listening to this who doesn't know what equity co-investment means and mezzanine loans are, can you just tell them, please?
Yes. So Lehman was a source of capital. And so if we were going to put equity cash into a project alongside a partner, it would be alongside an operating partner who was bringing the expertise. So that's the co-invest part. We would basically allow somebody to do more than they were capable of doing on their own balance sheet basis. Sometimes we did that with equity, and sometimes if they needed to plug the gap because they didn't have enough money, we would come in with a mezzanine loan. And that basically means you normally get a loan, which we call senior, which is effectively just like a mortgage on your house. And then the rest of it is cash. The mezzanine sits in the middle. So it's slightly more equity-like in its risk profile, and it costs more than senior, obviously, because it's more risky.
And so you were working across both equity investment and mezz tranches as well. Still within direct real estate. So were you doing a lot of screening of operating partners and deals at this stage? And had your role materially changed from what you'd previously done, or was it similar but with just a slightly different lens?
I think it's a different lens. It was a different risk profile as well, from having worked doing right at the very start, doing the work with the pension fund, which was very much core return, so low risk, lower returns. We were working with some amazing operating partners. I mean, at the time we did joint ventures with Unite students, and this was early 2000s, so maybe 2003, 2004. That's a very mature market. Unite are obviously, they're one of the largest players in that market and very well established. But at the time, it was a fairly fledgling company. That feels wrong to say right now, but they were trying to grow. They had, again, constraints on their balance sheet as to what they could do, constraints really from, they were listed from the stock exchanges to the size of projects they could do. So we did 2 of their larger deals with them, and development deals, and just meant that some of the risk that they were taking there was lower. But it was people like that we were doing deals with. So amazing operators, just people who needed people to believe in that sector when that sector at the time was immature.
Talk to me about the GFC and Lehman, because you obviously went through it.
I did.
And I'm sure we could probably do 5 podcasts on it. So
can.
the kind of the top line on it, because I know you left in 2011.
Yes.
Talk to me about that kind of period and the market and what your role looked like then.
So, I mean, if we cast our minds back, 2007, August 2007, I think it was, we had Northern Rock issues, or what went on with Northern Rock and all those queues outside, if you remember all of that. And that was sort of a big shock to the market. But the market then carried on a bit longer, was limping along. And then in March, we had Bear Stearns. I remember we were all at MIPIM when we got the announcement that Bear Stearns was in trouble and was being rescued. And we all knew that, things weren't going well. We were all in a process of trying to work out positions that we had and make sure that the risk that we were taking was lowered, etc. At the time, we had a number of positions in Lehman's balance sheet. And what we were doing, and this was subsequently done by others after Lehman went bust, we just didn't get there quickly enough, was we were setting up bad bank and good bank. And there was going to be a split. And everyone who had shares in Lehman would get shares in both, and there would be liquidity of both, which would meant really that, you by getting bad bank away, good bank could then sort of be free to do what it wanted again. So I worked on every single position on the European balance sheet for real estate, because I was going to be reporting to someone in the US who was going to be running bad bank real estate. So I basically spent the entire summer in a room going through every single position, making sure that I understood it so that we could move stuff away and know that, what the valuation was, etc. What that meant was we didn't get there in time. The shorting of the market of the Lehman stock meant that, insolvency came about. And we tried very hard to see if we could get some liquidity right at the last moment. I distinctly remember being in a Madonna concert at Wembley, actually, and being called into the office at 11 o'clock at night and thinking, this doesn't sound very good. And I didn't leave again until the Sunday. I think that was probably 4 or 5 days that I didn't leave the office. And would just put my head down on the desk and sleep for a bit and carry on. But by the Sunday, we knew. I mean, I came home and knew that the phone hadn't rung. No one had asked us any questions for 24 hours. It's like no one's out there buying us. But what it meant on the Monday, when I came in and we had administrators running around trying to sort of sort everything out, was when they said, okay, who knows most about all of these positions? It was like, okay, I've spent the last X number of months getting to know everything because I was going to be staying with those assets and not with a new thing. So there were 3 of us who stayed, and then we actually managed to get jobs for other people just because of the scope of the work that we needed to do. But fundamentally, there were 3 of us who were working through it with PwC in the UK administration. It then became clear that a lot of the European assets actually were under the US administration, not the UK one, just because of where the company sat and where their parents are. And so in January, I actually moved to the US one, having sort of worked for 3 months with PwC and let them understand everything that was in theirs. The US administration was a lot easier to work with. The structure they've got there is that you have this moratorium, but you can still, trade's not the right word, but you can do a lot more under the US and, Chapter 11 than you can under UK administration. And so we actually went and invested more money by buying in other positions around the ones that we had so that we would end up with a better value. Yeah. And you can do that on the basis that the money that you're investing is safe and it'll improve the value of the thing that you've already got. Yeah. So if we owned like 20% of the loan, we would go and buy the remaining loan. And that just meant that there was better liquidity, or you could actually speak.
More control?
More control, exactly, with borrowers and sort things out more. When you weren't dealing at the time, you were dealing with a lot of people who were all trying to work out what they were doing, because all of these things are,
They're all fragmented and actually bring it closer together, more control, more certainty over it.
So a lot of it involved, once again, it's all around sort of, okay, what do you know, and the sort of breadth of how you can think about things. Lots of pivoting to sort of think about how you can, make the best out of that situation, and reading a lot of documents and every single word, which has probably made me slightly paranoid after that when I'm doing legal documents, because every word counts.
Yeah, especially for someone who doesn't like sitting still, as you said.
I can do it. I can do it if I need to. But if you ask me to work for a year on one thing, then I can't do it. But no, I can focus on documents, and every single word counted at that point. That was a lot of learning.
Again, that period must have supercharged your experience in comparison to some of your peers at other shops, just in terms of the amount of work that you're getting through, the intensity of it, the pressure around it as well.
I think that's right. I mean, actually, when you look back at it, as I say, the Chapter 11 administration or insolvency, because it allowed us to do things, actually meant we were one of the only people who were able to do this. There were a lot of other people sitting in other banks who weren't allowed to change anything because of fear of, crystallizing anything, basically. And they wanted to sort of, work through things over a very long-term period. Because Lehman had gone bust, everybody knew that, we couldn't get any worse, right? We were already at the bottom, and therefore you sort of had, I think, much more scope and leeway to do stuff at a time when there was a lot of paralysis, which I think is your point. I totally agree.
You moved after a stint at Lehman to TIAA.
Yes.
For a short period before going back to Hudson. Can you just talk to me about that? Because I'm also keen to spend a bit of time in this conversation with Quintain and then more on thriving in the market as well. But just kind of trying to bring us up.
Yeah, that's fine. Of course I can. So at the time, as we say, the market was in paralysis. Most of the banks weren't lending at all because they were trying to sort out their loan books. And a lot of people were setting up debt funds because this was the sort of, okay, that's where we can get liquidity from. So TIAA was the pension fund that I'd been working with when I first moved out of Wetheralls and moved into fund management. And I'd always kept in contact with them. And I basically said, you guys have been in this market in Europe for so long. And actually in the States, your loan book, your real estate loan book is bigger than your equity book. So you have more loans than you do actually properties that you own in terms of dollars. But you don't have any loans in Europe. But you've been in the market for, I think at the time it was something like 17 years. This is your market. You need to be here. And at the time, people couldn't get a loan on anything like what they had been before. And low leverage loans were, had margins that were things that hadn't been seen for years at that level. But it really was a chance of like, the market has massively shifted. There's an absolute ability for new entrants to come in, and you need to come in. The hold on the market up until then, the European market has always been the liquidity, and it's come back a little bit to that, but the liquidity has always been around 5-year terms and floating rate. And that was mainly the UK banks and German lenders and that sort of ilk. So in the US, they have floating rate, but they also have this fixed rate debt, which is coming mainly from insurance companies, which is what TIAA was doing. And introducing that into Europe when the market was basically, looking inward and not able to sort of help its clients was the proposition that I went to them with and said, let's do this. We did it. We set it up. But in the meantime, TIAA were having conversations with Henderson, and that merger was happening.
Which is now Nuveen.
Exactly. And they had a debt fund that was being set up. Christian Jansen took that over and was running that. And so we had the sort of the balance sheet money, if you will, of TIAA on the fixed rate, and then we had the debt fund. And when we both got together and sort of, both businesses were put together, it was an interesting proposition, but it probably wasn't as interesting as it was for me when I was thinking about growing the business and working back in a small company.
Yeah. And
that's really the bit that I like, is the sort of, is being a bit more flexible about how to think about things. And this was back into a big company and thinking about things from much more of a sort of fund management perspective. And at the time, Lone Star, Hudson guys had come back from Germany, were now massively in the UK and buying NPLs in the UK. And they said, we need you to come over with your holistic view and try and help us with a whole load of transactions here.
And an NPL, for those who don't know what it is a non-performing loan.
Non-performing loan. So that's what the banks were selling off to clear their balance sheets so that they could then go forward and lend again.
And you guys were buying them at a discount, packaging them up, working them out, making a profit.
Exactly.
So talk to me about Quintain then, and how kind of the move out of that came around.
Yeah, so the non-performing loan market, exactly as you described, you buy in bulk and then you sort out, and it's actually quite a short period between the purchase and when you've sort of exited from that. The reason I came in was because I was taking a very holistic view across different markets, and they had been doing lots of different deals, and I was plucking things from different deals, putting them together as portfolios and selling them. So if I did my job well, I would be out of a job quickly.
Yeah.
And we did that. I mean, we were parceling up huge hundreds of millions of portfolios into markets whereby as soon as the debt market basically was opening up, that allowed us to sell on because that allowed other purchasers to come in and use the debt market there. And that's what we'd been doing. So that, again, was sort of plucking bits of information from all of the different parts of the career that I'd had and allowing us to sort of think, again, from a sort of big strategy, big picture strategy side of things about how we could transact. So when we were approaching the fact that actually, the number of NPLs that were remaining on the balance sheet were getting quite low, and that was, the sort of the bulk of stuff had been dealt with, the company had been looking at the take private of Quintain, and that was 2015. It occurred in September 2015, and I moved in January. And Quintain had been, as I say, a listed company. We took it private. As part of the take private, they repaid all of the company's debt and its bonds, but it had a massive amount of development to do. And the focus was to create build to rent in Wembley. And build to rent had been it had been around. Delancey were doing a lot of it with the Get Living in the old, in Stratford in the old Olympic site.
Park,
yeah. But not a lot had occurred other than that. Obviously M&G and I think Invesco were probably active all at that time. But in terms of, you had to create it, you had to develop it. It wasn't something that you could transact and buy in the market. And so the opportunity to get a load of land on a good transport hub in London and create this was very exciting. It was a different strategy to the one that the listed company had, mainly because the listed company had constraints about the amount of development and the amount of debt it could take on. But all of those constraints were gone. Now it was owned privately. And I came in basically to help them sort of supercharge that, get the investment in and understand and basically put the plan together. It sounds like I did it single-handedly. That's not what I'm trying to impart. We were mobilizing massive teams, from a group whereby, paraphrasing slightly, they were probably doing a new development every 18 months. We were starting new developments every 6 months. And these developments were 300 units plus, the largest one being almost 800 units in one go. And so the amount of money that was needed and invested and the resources from people and time and sort of coordination, etc., was huge. And so we actually got a big loan, an £800 million loan, the largest that anyone had ever given in development terms for years, and in a new sector, which was incredibly difficult because most people, when they're lending, want to know that, it's a sector that they know they can get out of and they're comfortable because it's trading. But it again went back to, I suppose, where, one of the things I've mentioned before, it's like if it's an immature sector, just like Unite was in students 20 years ago, this was an immature sector again, but you can draw on a whole load of different things to say to people, the risk is fine, and here's why.
But also, you must have been integral in that, having sat on the other side of the table and kind of seen and the quantum of work that you'd gone through for them to understand you and have trust in you. And I don't know if it was you who kind of originated and structured that £800 million loan. I'm sure there's a team and everyone else. But there must have been confidence in terms of the leadership team around signing that off and the business plan that you needed it for. Yeah,
exactly. But also the size of Lone Star and the depth of the amount of money that they've got behind it, and they'd invested in it. Simon Carter was the finance director at the time. He's obviously now CEO of British Land. So he and I were working on that loan together. And also just really trying to think about how we could do this in the most efficient manner. I suppose the normal way, if that's the right way of saying it, would be, and what most people had done, would you put a loan per property. But that means that you're using, the equity goes in and then your loan. And then once you've got to the point that it's up and running, you can then refinance it and refinance your loan out. What we had was this 800 million for everything. And it sort of meant that because of the fungible nature of it, you didn't have to put in so much equity, but everyone got everything as their the whole estate is here. And therefore your risk is lower because we're not going to let everything drop. Whereas if one property went wrong, the theory is that if it goes wrong, you could hand the keys back on that. Not that you would, but that is how it could work. So actually sort of trying to think about things on a more, again, looking at it from a different angle. And that's always the I suppose that's the intellectual challenge I quite like about lots of different things.
And the value in structuring it and the positioning part of it.
But for me also, the real interesting part about it was that, it's an operating business. And lots of things in real estate have been moving away from it being the landlord collects its check, and in 25 years at the end of the lease, it has a conversation with the tenant again. I'm being facetious, but everything was moving way more into that operating world, and I hadn't really done that much in operating businesses. So this was the first time that I could get very close and see and understand it because I was inside. And learning when everyone else was learning. So that for me was the major driver as to why to be there.
Talk to me about how PfP Capital came around and the role of joining as a chief exec. If you could just tell me about that, that'd be great.
Yeah, so I suppose the operating business part that I was talking about was fundamentally really different, but also very interesting. I mean, it's actually, it's residential. We all live in a home. We all understand it. We probably all think we're experts on it. But understanding how you can manage large amounts of homes, large amounts of customers, making sure that you are looking after your customers properly. It's a very different model to a lot of real estate.
Because it's so granular?
Because it's so granular, exactly.
And it's so emotionally charged because that's someone's actual home rather than, as you said, an office. It's just a lease and a place of work.
Exactly. But I think also, and lots of customers have much more vested in it, even if it is that they're renting and not owning. But I think it's a fascinating market. And we all know that there's a housing crisis. And you need lots of new houses coming on stream in all different tenures in order to even have a go at trying to solve that. And just building houses for people to buy. Okay, fine. But actually, what do people do until they can't buy? Does everybody want to buy? People make lifestyle choices really about what they want. Elsewhere in the world, lots of people are in the private rented sector and very happy. It's a very UK centralized thing that people are very focused on home ownership. And having an alternative for running a business properly where you treat your customers properly and professionally as a landlord, I just think is absolutely the right way to go for part of that solution. And so having worked at Quintain and we've developed thousands of units, leased them up, developed the operating business within the company as well. I really wanted to learn more about how we could do more of that elsewhere. And actually part of what we were doing as well was we actually sold off the affordable units at Quintain and didn't set ourselves up as a private registered provider. But that was something that was of quite a lot of interest to me, because solving the affordability issue is again a massive part of the housing crisis. And so the PfP Capital role was really interesting, and for a number of reasons. I think it's unique in the way it sits. It is a fund manager with all of the credentials of being a fund manager. It's regulated by the Financial Conduct Authority, so we can look after people's money and on a discretionary basis. Not all of everything we do is on that basis. We have joint ventures as well. It has great clients, blue chip clients. It's been established for years, but it had not grown anything like it could have done in a period of growth for the residential market that we've seen over the last few years. And I know that what I can do is help people grow and think about things from a different point of view. But it also, because of its ownership through Places for People Group, which is a registered provider but has a number of other businesses as well, it just means that things like all of the profits from our business go back into the registered provider business and creates more housing. And the circularity of that, I thought, was amazing. Really liked the fact that you can, and I said it before in another interview, that you can make profits, not be ashamed about it, because making profits is the way to bring investment into that market. Right? All pension funds are trying to solve is, I need a return on my money because I need to give all pensioners a return on the money that they've invested with us. And so, if we want pension funds to come in and create more homes to help us, we need to show them that there are good returns and not be ashamed about that. But at the same time, you can create social impact. You can create things that are helping communities, that are helping your customers, etc. And that sort of purpose comes in bags and bags with the group that we're part of. The amount of social impact projects that they're working on, the social value projects we do, the focus on the customer, the focus on health and well-being, education, employment for all customers. And we're rolling that out not just to the direct customers of the group, but also the indirect ones for people that are within the fund management business and some of our management businesses as well. So we have this vertically integrated company where we can source, develop, manage, and investment manage and exit as well. So we can go all the way through the whole cycle and do it extremely well. And it's got a track record in it and create purpose. It's sort of, it felt too good to be true, to be honest.
You mentioned a couple of things in there. One is an RP.
Yes.
Can you, someone who doesn't know what an RP is, can you just explain what that is? And I think you've kind of gone a little bit in terms of
that's fine. So I suppose the old parlance is Housing Association.
Yeah.
So RP is registered provider. So anyone who wants to employ grants and look after capital A affordable housing needs to be a registered provider, which means they're regulated by the Regulator for Social Housing. So our parent is, and you can get, and they're a not-for-profit registered provider, which means all of the money they make gets rolled back into creating more housing. You can get a for-profit registered provider, which means that you are regulated, but you can also dividend money back out. And that's the ones that pension funds come into so that they can take money out. And
they operate a lot of the assets that you will go and build. Is that correct? Or
actually, it can be operated by, we have management companies that are in the group called Touchstone and RMG Residential Management Group. They're the ones that manage it for us. But in terms of understanding of how to run a regulated entity, we've done it for nearly 50 years within Places for People Group. There's a wealth of experience and knowledge about how to invest in and manage affordable homes.
So you've got kind of 3 investment strategies, don't you?
At the moment.
At the business.
Yeah.
Can you just talk to me about the name change to Thriving Investments, and then talk to me about those 3 different strategies that you currently have?
Yeah, of course. So when I joined at the beginning of the year, And as you mentioned at the beginning, we were called PfP Capital. And the brand awareness was quite low. What I wanted to do was drive brand awareness, but also I wasn't sure that that was the right brand, that we were telling people what our values were. And I really think it's important that people try and understand the sort of things that we wanted to do. Now, I'm not a marketing person. And I was just basically looking at it saying, well, we do investments and we're in the living sector. So why don't we call ourselves Living Investments? And I think I probably still own the domain names for those as well somewhere. But the people in the group who are in brand and marketing were like, why don't we just, think about that a bit more and see if we can come up with something that's, not quite so utilitarian.
Yeah, your very small marketing slice in your MBA a couple of years ago. Yeah.
And so we did this thing called a co-create, which was fascinating. And we got a whole load of stakeholders in and people from around the business and within the business and talked about what it is we are. And what we kept coming back to is we're all about making sure we invest properly and we invest and get the right returns for our customers and our clients. But at the same time, we're about doing that with the social conscience and we're about creating social impact. And we get the two of those things come hand in hand together. And we don't want to focus on one to the exclusion of the other, because then it doesn't work. If you only focus on social impact and you don't take care of your returns, your pension fund investors,
they're not going to turn up.
Or just not going to turn up, right. But if you only focus on your returns and don't look after social impact, well, then you're not doing what the purpose of what we want to do in the group is. And so those things really, we kept saying the whole time, it's like, I think one of the analogies was, it's like when you crack an egg open, you get two yolks, you get both at the same time in one go. And so actually what we were trying to then say is it's not just living, it's thriving. It's sort of elevated from that. And that's not to say that actually I had somebody say to me, does that mean that everyone who's got the word living in their company isn't doing it right? It's not at all. It's us just trying to sort of say what we've got as our purpose, which is we do the living part, but we do another bit as well, which is we try to make sure everyone is thriving when they do it. And the thriving part is about thriving communities, about that social impact that we bring. It could be direct, it can be indirect, it can be both. The direct can be about what we're doing and creating and that we're providing more affordable housing. And the indirect is that everything that we do and our sister companies who manage it with us, profits go back to the company and they create more social housing for those profits. And that was it really. And just sort of having that as our name and then getting the brand awareness higher because, we're trying to grow the company. I want more people to know what we're doing. It just felt like doing that through that new brand was the right way. And so we've got a lot of taglines that we use as well. And they always come as couplets to try and show those two sides. My favorite being community gains, capital wins, which is a bit of a play on words on capital gains, etc. But it sort of encapsulates really what we're after.
Talk to me about the three strategies that you
that we've currently got.
Yeah, that you've currently got. Because if I'm not wrong, they're called Picture Living, New Avenue Living, and then Igloo Developments.
That's right. So Picture Living has been going for over 5 years now, and it's, I suppose, old parlance PRS, new parlance suburban build to rent, which effectively means single family housing and low-rise apartment blocks. So not what we were creating at Quintain in London, the sort of heavily amenitized, more high-rise apartments, but regional, spread all over the UK. It's got around 1,800 homes or something in it at the moment, and it's continuing to grow. And we buy small amounts of homes in locations all around the country. That's a joint venture with USS, University Superannuation Scheme. And then New Avenue Living is our key worker fund. It's in Scotland. We love this concept, totally. It's for us, it helps what we call the squeeze middle, which are the people who find market value renting too spicy. It's too expensive for them in locations they want to be, but they earn too much to ever get to the top of a housing list. And so they're in this middle where they're sort of like, I need accommodation, I need to rent, or buy, I suppose. But I need it to be at a discounted level. And so it's an intermediate, really, strategy. And that's what we've been creating in Scotland. We have over 1,100 homes now on that. They're all new build. They're all EPC A or B, so low energy bills as well. So the cost of occupancy is low. And they're all at a discount to market rent, roughly between 50 to 75% of what the market rents are. And you have to have you have to qualify by having a salary or household income that is below a threshold.
Yeah.
So it is aimed at key workers or people of lower salaries, but it still means they can commute easily to their place of work. And that's something that we are looking to roll out elsewhere, basically. It's a very interesting strategy for us, and it's one that, as I say, we're really quite focused on that sector of the market. Housing associations look after the sort of real affordable social rent side. Market value, we've got our own strategy, but lots of people are on, really to try and help the people who are in that where affordability is, the biggest issue, especially in the cost of living crisis. And then our last one is Igloo. That's a partnership that we've had for a number of years. And we actually bought the company in January, so they're now a subsidiary of us. They are a regeneration, development company for regeneration. They, again, are UK-wide and very focused on net zero or net positive homes. So what we're after there is zero bills, effectively. And they're creating those in partnerships all around the country. As you said, we have got 6 schemes up and running right now.
So a portfolio of about 700 million, 3,500 private rented sector and for sale homes, as well as the 6 regen projects.
Yeah.
You've got a target of 20,000 homes.
Yeah.
How are you going to get there, and what are the strategies in the offing?
So we've talked about one of them, which is this for-profit RP. And we're going down the route of, it makes sense for us to be doing capital A, affordable, more regulated tenancies as well. So we're setting that up and talking to different investors about that strategy. So that's one. We have the ability within the Places for People group to access stock that they're building, which can come into that strategy, and we can buy in the open market as well. We will continue to grow our market value as well. As we say, I think the whole point about sort of trying to deliver homes is that you do it in a number of different tenures. So we are growing the private rented market value one, but it's at a small A affordable level. We make sure the affordability is right for the median incomes in the area. We will be growing our key worker, and we're also looking at student as well. And the rationale for us looking at things like student are, there's been lots of stories, haven't there, about affordability of students. And if you look at the affordability, I think the National Union of Students says that affordable should be £130 per week that a student is paying for its accommodation. It's about 20%, I think, of the stock is at that level. So 80% by definition, if I've got my numbers right, is unaffordable. And my concern, or our general concern with that, is that you're going to then have, university education will become elitist and only available to those who can afford these elevated levels. And we're not alone in that. Lots of student accommodation providers are all trying to, make sure that there is affordability across the range. But again, it just comes down to supply. And so we're looking at how we can come into that market, but specifically around making it affordable. And at that lower level. So not maybe, looking less at things like studios and 2DOs, but looking more at cluster flats, looking at making sure it's a discount to, where the prices are for that market, etc.
I've got so many more questions. I feel I could ask you for hours and hours and hours. I'm just mindful of time. You've had a fascinating career, as you've shared. I get the real sense that relationships and kind of trust is really important to you as you've kind of gone back and leveraged existing relationships over your career. And obviously recently appointed Jamie Younger as fund manager out of Patrizia, having worked with him back in your Lehman days, right?
And at Parks and Company.
And I'm really excited to see what you and the team go on to do. Can you just offer up a bit of advice for maybe someone who's early on in their career? Like, what advice would you give them who might be a surveyor at a surveying practice right now, who might have listened to this and gone, well, she's worked in the US, Europe, banking. She's been on the equity side, corporate finance. You've kind of been able to evolve and drive your career forward at rapid pace. What advice would you would you give to someone?
I think it's that sometimes when you want to move forward, it's not a direct line forward. So there's this book called The Squiggly Career, and actually the line should be going all over the place, because that's when you learn and you see the breadth. And don't be afraid to move sideways, even if it's sideways and a little bit back, because then you might find that you've opened up something that you can move much more quickly in, or it can advance your career in so many different ways. And I've taken that sideways step, possibly backwards, a number of times and said, okay, I'm fine with, I don't have to move and get, a promotion and a different title, etc. I'm moving because I'm going to be learning something that is a gap, and it's a skills gap that I have and that I think I need. And that's really what's governed how I've tried to move in my career. And if you get too comfortable, you're not learning, you're not growing. And I enjoy working with people who are fine with being uncomfortable, because that means that we're all trying to think about things and learn things and do things in a slightly different way. And that's not in a way to be different for the sake of being different, but especially in a market like we've got today, it's a market whereby, interest rates have suddenly rose, and we're all in this new paradigm, and lots of people are still trying to work out, has the market settled? Am I interested in investing at this level, or whatever it might be? So, if you're sitting there and trying to do what you were doing 3 years ago, it's not going to work. You have to keep pivoting, and you have to keep looking for different ways to find routes to get things to happen. And that comes from working with people who are comfortable to make that change and think flexibly. And that's who I like to surround myself with. And as I say, I've worked with Jamie this is the third time. I'd be very happy to work with other people I've worked with before. And I've also returned, as I said before, to other things. Worked at Lone Star twice, worked with teachers twice. Moving away from people and keeping those relationships strong is absolutely the number one thing to do. This market is all about the people that you can call on and talk to and understand and move forward with, right?
A question as we draw to an end that I ask everyone who comes on the podcast is, if I gave you £500 million worth of capital, who are the people, what property, and which place would you allocate that capital?
So I'm going to make the assumption, seeing as it's a hypothetical 500 million, that it's an extra 500 million and not my first.
Correct.
I like the idea of doing it for things that are purposeful. So housing for me is just the biggest crisis we've got in the UK right now. So it has to be with that. But also I think in things like moving us forward in things like renewable energy and infrastructure. I think those markets, both of those markets, I see housing anyway, with one foot in real estate and one foot in the infrastructure market. It would be in those areas, and you could play in different sort of areas of the risk spectrum with them to get different types of returns. But that's most definitely where I would put it.
Across the UK?
Across the UK.
And any people that you'd bring on the journey in terms of deploying that capital?
Oh, the team I've got right now.
Anyone outside of your team?
Yeah, I suppose mentors I've had along the way. They'd blush if I mention them, but I've had a number of people that I've worked with, again, on numerous occasions, and very happy to work with them again. They know who they are.
Well, Kath, like I said, you've had a fascinating background, career. Your energy is infectious, and I'm really excited to see what you and the team go on to do at Thriving Investments.
Thanks, Matt.
Thanks for listening to this week's episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Give us a rating, like, or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests that we should have on the show, or areas of the market we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockborn. The team recruit leadership and future leadership hires for real estate owners, funds, investors, and developers. So if you're looking to hire top talent for your business, head over to the website www.rockborn.com, where you'll be able to find a wealth of information, or feel free to drop me a message on LinkedIn. Have a great day wherever you are, and I look forward to catching you next time.